Well, thank you for being here today. If you want to lose your money fast in 2026, trust me, there's no shortage of creative options. In fact, I'd say we've entered a golden age for separating people from their capital. The technology has never been better. The distractions have never been more plentiful. And human nature, well, that hasn't changed one bit in the 95 years I've been alive. I'm going to spend some time today talking about how to lose money in 2026. Not because I want you to lose money, obviously, but because I've learned over 8 decades of investing that understanding what not to do is often more valuable than understanding what to do. As Charlie Munger used to say, avoiding stupidity is easier than seeking brilliance. Now, 2026 is shaping up to be a particularly interesting year. We've got AI valuations that would make the dot-com bubble blush. We've got interest rates that are higher than they've been in years, putting pressure on everything from mortgages to corporate valuations. We've got geopolitical uncertainty from multiple directions. We've got crypto making another run, meme stocks still capturing imaginations, and we've got an election year, which always brings its own special brand of volatility and prediction making. And in the middle of all this, we've got millions of people who are absolutely convinced they can get rich quickly if they just follow the right influencer, buy the right hot stock, or time the market perfectly. These people are going to lose money, a lot of money. And I want to help you make sure you're not one of them. The theme I want you to take away today is simple. In 2026, the easiest way to lose your money is to do what everyone else is doing. Follow the crowd, chase the hype, react emotionally, and you will lose. It's as simple as that. Let me start by explaining why most people will lose money in 2026. Because if you understand the psychology, you can avoid the trap. First, people repeat the same mistakes every single cycle. I've watched this happen for over 80 years. The technology changes, the hot sectors change, the specific stocks change, but the behavior is identical. People get greedy during bull markets. They get fearful during bear markets. They chase what's already gone up. They sell what's already gone down. It's like watching the same movie over and over with different actors. In the 1,960 seconds, it was the Nifty 50. In the 1,980 seconds, it was junk bonds. In the 1,990 seconds, it was dot-coms. In the 2000s, it was housing. Recently, it's been crypto and meme stocks. And now it's AI. The details change, but the pattern is always the same. Optimism turns to euphoria, valuations become untethered from reality, and eventually gravity reasserts itself. Second, people are overconfident because markets recovered in 2025. If the market went up last year, people assume it'll keep going up. They forget that markets move in cycles. They forget that bull markets don't last forever. They extrapolate recent trends indefinitely into the future, which is one of the most expensive mistakes you can make. I remember in 1999, people were convinced the internet meant the old rules didn't apply anymore. Profits didn't matter, valuations didn't matter. Just buy anything with .com in the name and you'd get rich. Then 2000 came and trillions of dollars vanished. The people who were most confident in 1999 were the most devastated in 2000. Third, people treat speculation as investing. They buy things not because they understand the business or think it's fairly valued, but because they hope the price will go up so they can sell to someone else. That's not investing. That's speculation. And speculation is most dangerous when it looks easiest, when everyone seems to be making money, when you feel stupid for not participating. Risk comes from not knowing what you're doing. That's one of my favorite lines because it's so true. Most people who lose money don't realize they're taking enormous risks. They think they're being smart, sophisticated, informed, but they're actually gambling on things they fundamentally don't understand. Fourth, people want quick profits. They can't stand the idea of building wealth slowly over decades through compounding. They want to double their money in 6 months, not 10% a year for 30 years. This impatience is fatal. The stock market is designed to transfer money from the impatient to the patient, and 2026 will be no different. Fifth, people ignore fundamentals. They buy stories, not businesses. They buy hype, not earnings. They care about what the stock price did yesterday, not whether the company generates positive cash flow. This disconnect between price and value This is where most money is lost. Now, let me give you the money-losing formula for 2026. If you do these things, I can pretty much guarantee you'll lose money. Number one, chase AI stocks at insane valuations. Right now, anything with artificial intelligence in its business description is trading at valuations that make no sense. Companies with no profits, no clear path to profitability, no competitive advantages, they're worth billions just because they're in a hot sector. This is exactly what happened with internet stocks in 1999. The technology was real and transformative, which it was, but that didn't justify paying 100 times sales for unprofitable companies. When you pay absurd prices, even if the company succeeds, your returns will be terrible. I remember watching this happen with the Nifty 50 in the 1,960 seconds. People paid 80, 90, 100 times earnings for companies like Polaroid and Xerox because they were convinced these growth stocks could be held forever at any price. Then the 1,970 seconds came, and most of those stocks dropped 70 or 80% and never recovered. Number two, buy companies with no profits. I've been investing for 83 years, and I've learned one simple truth. Companies that don't make money eventually run out of money. In a zero interest rate environment, unprofitable companies could keep raising capital cheaply. But interest rates are higher now, capital is more expensive. Companies that can't generate profits and positive cash flow are in serious trouble. During the dot-com bubble, I watched hundreds of companies burn through billions in venture capital and investor money, never generating a penny of profit. Then the funding dried up, and they went to zero. Their shareholders lost everything. Number three, trade based on YouTube or Twitter predictions. Every day, there are influencers making bold predictions about what stocks will 10x, what sectors will boom, what the Fed will do, where the market is headed. And every day, people make investment decisions based on these predictions. But here's what I've learned. Nobody can consistently predict short-term market movements. The people making the boldest predictions are usually the ones who understand markets the least. They're entertainers, not investors. They're trying to get views and likes, not to protect your capital. I've never made an investment based on someone else's prediction. I look at businesses, I look at valuations, I look at competitive advantages. I ignore the noise. Number four, try to time the market. People think they can sell before crashes and buy before recoveries. They think they're smart enough to predict when to get in and out. I've been watching people try to time the market for 80 years, and I've yet to see anyone do it successfully and consistently. What actually happens is people sell after the market has already declined, locking in losses. Then they sit in cash waiting for clarity, which only comes after the market has already recovered. They end up selling low and buying high, exactly backwards. In 2020, millions of people sold in March when the market crashed 34%. They were certain the economy would be destroyed for years. 5 months later, the market had fully recovered. The people who sold in panic missed one of the fastest recoveries in history. Number five, use margin and leverage. This is the fastest way to financial ruin that I know of. When you borrow money to invest, you turn temporary volatility into permanent loss. You get margin calls at the worst possible time. You're forced to sell when you should be buying. I watched brilliant people, successful in their careers, lose everything because they used leverage. One market crash, one margin call, and decades of wealth building evaporated. Never borrow money to invest, ever. Number six, bet everything on a single hot theme. Maybe it's AI, maybe it's green energy, maybe it's crypto, whatever the hot theme is. Putting all your eggs in that one basket is a recipe for disaster. When sentiment shifts, when the theme falls out of favor, your entire portfolio gets crushed. I remember in 2000, people had portfolios that were 100% internet stocks. They were convinced the internet was the future, which was true, but they ignored diversification and valuation. When the bubble burst, they lost everything. Number seven, react emotionally to news. Every day, there are headlines designed to make you scared or excited. Every day, there are reasons to panic or reasons to get euphoric. If you make investment decisions based on these emotions, you will lose money. The wealthy investors I know, they ignore the daily noise. They focus on business fundamentals and long-term value. They don't react to every headline, every tweet, every pundit's opinion. Number 8, panic during dips. When the market drops 10 or 20%, most people panic. They see their portfolio declining and they can't take it. So they sell, locking in losses. Then they miss the recovery. But if you own quality businesses at reasonable prices, temporary price declines are just noise. They're not losses unless you sell. In fact, they're opportunities if you have cash to deploy. Number 9, believe election year predictions. 2026 is an election year, and there will be endless predictions about what happens if this party wins or that party wins. People will make investment decisions based on political outcomes they think they can predict. But American business thrives under both parties. It always has. Good businesses adapt to whatever political reality exists. I've never made an investment decision based on who's in the White House or who controls Congress. Number 10, confuse movement with progress. People trade constantly. They buy and sell and switch strategies and chase performance. They feel like all this activity means they're doing something productive, but movement isn't progress. In fact, all that activity usually just generates fees, taxes, and bad decisions. The wealthiest investors I know, they do very little. They buy quality businesses and hold them for decades. They let compounding do the work. They understand that sometimes the best action is inaction. Now, let me talk about the specific dangerous trends I'm seeing for 2026, areas where I think people are particularly likely to lose money. First, the AI bubble. I'm seeing valuations that remind me very much of 1,999. Companies with no earnings trading at market caps of tens of billions. Investors paying any price for any company with AI in its name. This speculation will end badly for most participants. Second, unproven tech companies. The era of cheap money allowed lots of unprofitable tech companies to survive by continually raising capital. But with higher interest rates, many of these companies can't afford to keep losing money. They'll either need to become profitable quickly or they'll fail. Third, crypto making another run. I've been very clear about my views on cryptocurrency. It has no intrinsic value. It produces nothing. Its entire value depends on finding someone willing to pay more for it than you did. This is speculation in its purest form, and most people who speculate in crypto lose money. Fourth, meme stocks and coordinated pumps. There are groups online organizing to pump certain stocks, trying to create short squeezes of momentum. This is gambling, not investing. Most people who participate lose money. The early movers might profit, but the majority who pile in late get crushed. Fifth, buy now, pay later debt. Consumer debt levels are rising, and a lot of it is hidden in these buy now, pay later services. People are buying things they can't afford, and when economic conditions tighten, these debts become crushing burdens. Sixth, commercial real estate problems. With remote work becoming permanent, commercial real estate values are under enormous pressure. A lot of buildings are worth far less than their mortgages. This is creating stress in the banking system and in real estate investment portfolios. Seventh, high interest rates putting pressure on valuations. When interest rates were zero, any earnings yield looked attractive. But now with treasury bills yielding 4 or 5%, stocks need to compete with that. Many stocks that were considered reasonably valued in 2020 are now overvalued. Eighth, overpriced IPOs. There will be companies going public in 2026 at ridiculous valuations. The investment banks will hype them. The media will cover them. Retail investors will rush in. And most of these IPOs will be terrible investments. I don't have to predict exactly when or how these problems will manifest. I just know the sky looks awfully dark in these areas and I'm staying away. Now let me talk about how people fool themselves. Because understanding your own psychology is critical to avoiding losses. First, impatience. This is the biggest problem most investors have. They want results now. They can't stand building wealth slowly. So they take shortcuts, they speculate, they chase performance, and they lose. Charlie used to say, it's not supposed to be easy. If it were easy, everyone would be rich. Building wealth requires patience, discipline, and the ability to delay gratification. Most people don't have these qualities. Second, herd mentality. People look around and see what everyone else is doing, and they assume that must be smart. If everyone is buying AI stocks, there must be something to it. If everyone is day trading, maybe I should too. But the crowd is usually wrong at extremes. When everyone is optimistic, that's when you should be cautious. When everyone is pessimistic, that's when opportunities emerge. Third, overconfidence. People have a few successful investments, and they think they figured it out. They think they're special, smarter than the market, immune to the risks that affect everyone else. This overconfidence makes them take bigger risks, use leverage, concentrate their portfolios, ignore diversification. Then when things go wrong, the losses are catastrophic. Fourth, social media, FOMO. People see others posting about their gains, showing off their lifestyles, bragging about their portfolios. This creates intense pressure to keep up, to match those returns, to not miss out. But what you see on social media is curated, biased, and often fake. You see the winners posting about their gains. You don't see the losers who lost everything. This creates a distorted view of reality that leads to terrible decisions. Fifth, envy and comparison. People measure themselves against others. They see their neighbor getting rich on some stock and they feel like failures. So they chase that same stock, usually right before it crashes. Wealth building is a personal journey. Your only comparison should be to your past self. Are you making progress toward your goals? That's all that matters. Sixth, thinking this time is different. Every bubble, every mania, every speculative frenzy, people convince themselves that the old rules don't apply. This time is different because of technology, or because of monetary policy, or because of some new paradigm. It's never different. Human nature doesn't change. Mathematics doesn't change. Business fundamentals don't change. The details change, but the underlying dynamics are always the same. Let me share some stories from my own life about losing money and watching others lose money. When I was 11 years old, I bought my first stock, 3 shares of City Service Preferred at $38 per share. Immediately after I bought it, the stock dropped to $27. I was terrified. I'd lost over $30 on paper, which was weeks of earnings from my paper route. When it recovered to $40, I sold, relieved to have my money back with a small profit. Then I watched it climb to $200. I'd let fear drive my decision instead of value. That lesson cost me sleep, but it taught me about patience and temperament. In the 1,970 seconds, I watched friends and colleagues try to get clever. They'd predict recessions and sell everything. They'd predict recoveries and lever up. They'd switch between stocks and bonds and cash based on their macroeconomic forecasts. Almost all of them underperformed simple buy and hold strategies. Their attempts to be smart made them poor. The people who just bought quality businesses and held them did far better. During the dot-com bubble, I watched supposedly intelligent people, educated, successful in other fields, lose their entire fortunes speculating on internet stocks. They'd mortgage their houses to buy more shares. They'd use margin to increase their bets. They'd concentrate everything in a single sector. When the bubble burst, they were wiped out. Decades of savings, gone. Retirements destroyed. Families stressed, all because they abandoned basic principles in pursuit of quick wealth. In 2008, I watched people lose their homes because they'd taken on too much leverage. They'd borrowed to invest, or they'd bought houses they couldn't afford, or they'd refinanced to pull out equity. When the crisis hit, they couldn't service their debts. They were forced to sell at terrible prices. Leverage turned a manageable problem into a catastrophe. These stories all have the same theme: smart people making stupid decisions because they abandoned fundamental principles. They used leverage, they speculated, they followed crowds, they let emotions drive, their actions. Now, let me tell you what I will never do in 2026, because these are the behaviors that will help you avoid losing money. I will never borrow money to invest. No margin, no leverage, no debt. This is non-negotiable. Leverage is how most fortunes are destroyed. I've seen it happen too many times. I will never chase hype. When everyone is excited about something, when valuations make no sense, when the story is more important than the fundamentals, I stay away. I don't care about missing out. I will never buy something I don't understand. If I can't explain how business makes money, if I don't understand its competitive position, if I'm not confident about its prospects in 10 years, I don't invest. I will never rely on predictions about interest rates, the economy, elections, or markets. These things are unpredictable, and basing investment decisions on them is foolish. I will never buy unprofitable companies hoping they'll eventually make money. I want businesses that generate cash today, not promises about tomorrow. I will never react emotionally to short-term news. Headlines are designed to provoke emotional reactions. Investment decisions should be based on rational analysis, not on feelings. I will never put all my money into a single idea or theme. Diversification protects against mistakes and bad luck. Concentration might feel exciting, but one wrong decision shouldn't destroy you. I will never follow the crowd. When everyone is doing something, that's usually a sign to do the opposite, or at least be very cautious. I will never confuse volatility with risk. Volatility is just price fluctuation. Risk is permanent loss of capital. These are different things, and understanding the difference is critical. Only when the tide goes out do you discover who's been swimming naked. In 2026, the tide will go out at some point. Maybe not immediately, maybe not predictably, but it will. And when it does, all the people using leverage, chasing hype, speculating recklessly, they'll be exposed. So what should you do instead? Let me give you the smart approach to 2026. Focus on cash flow generating businesses. Buy companies that make actual profits, that generate positive cash flow, that return money to shareholders through dividends and buybacks. These businesses have intrinsic value that doesn't depend on speculation. Buy wonderful companies at fair prices. Look for businesses with durable competitive advantages, strong management, consistent profitability, and reasonable valuations. Don't overpay, even for great businesses. Hold for decades. Your time horizon should be measured in years and decades, not days and months. Time is the friend of the wonderful business. Let compounding work its magic. Keep large cash reserves. Cash gives you optionality. It lets you act when opportunities arise. It protects you from forced selling. At Berkshire, we always maintain substantial cash reserves, and individuals should too. Ignore predictions and political noise. Don't make investment decisions based on election outcomes or economic forecasts. Focus on business quality and valuation, not on things you can't predict or control. Avoid complexity. Simple strategies usually work better than complex ones. For most people, a low-cost S&P 500 index fund is perfect. You don't need sophisticated strategies or exotic investments. Understand your circle of competence. Only invest in things you genuinely understand. If you don't understand tech, don't invest in tech. If you don't understand biotech, stay away. Stick to what you know. Use dollar cost averaging. Invest a fixed amount regularly, regardless of market conditions. This removes emotion and timing from the equation. You buy more when prices are low, less when prices are high. Prioritize temperament over intelligence. Your ability to stay calm, think independently, be patient, and control emotions is more valuable than IQ or information. The smartest people often lose money because they can't control their behavior. Now, let me give you specific steps to protect yourself from losing money in 2026. First, eliminate high interest debt, credit card debt, car loans, anything with high interest rates. Pay those off before you invest a dollar. You can't earn your way out of 18% interest. Second, keep emergency liquidity, 6 to 12 months of living expenses in a savings account or money market fund. This protects you from having to sell investments at the wrong time. Third, invest gradually. Don't put all your available capital to work immediately. Invest over time, so if prices decline, you can buy more at better prices. Fourth, don't chase returns. Don't buy last year's winners. Don't follow hot sectors. Stick to your strategy, regardless of what performed well recently. Fifth, maintain diversification. Don't put all your eggs in one basket, no matter how confident you are. Diversification protects against mistakes and unexpected events. Sixth, buy productive assets, not speculation. Own businesses that generate profits, real estate that generates rent, bonds that pay interest. Don't speculate on things with no intrinsic value. Seventh, don't sell during volatility. If you own quality businesses at reasonable prices, temporary price declines are irrelevant. Stay the course. Eighth, reinvest dividends. Let every dollar go back to work. Don't take the cash unless you need it for living expenses. Reinvested dividends are a huge component of long-term returns. Also, develop long-term thinking. Train yourself to think in 5, 10, 20-year horizons. This perspective makes you immune to short-term noise. Practice emotional control. When you feel scared or excited, pause. Don't make decisions in emotional states. Wait until you're calm and rational. And avoid financial media panic. Turn off the television. Stop reading panic headlines. They're designed to provoke emotional reactions, not to help you make good decisions. Let me close with a final warning and some wisdom. If you want to lose money in 2026, follow the crowd. Do what everyone else is doing. Chase what's hot. React emotionally. Try to get rich quick. Use leverage. Speculate instead of invest. If you want to protect and grow your wealth, do the opposite. Slow down. Think long term. Stay disciplined. Focus on quality. Be patient. Temperament beats intelligence in investing. The ability to stay calm when others panic, to think independently when others follow the herd, to be patient when others demand instant results, this is more valuable than any information or analysis. Be fearful when others are greedy, and greedy when others are fearful. This principle has worked for me for over 80 years. It'll work in 2026 too. Never bet against America. We have problems, yes. There's uncertainty, yes. But American business has overcome every challenge for over 2 centuries. Innovation, capitalism, and human ingenuity are powerful forces.
Discipline is your greatest financial advantage. In a world where everyone wants instant results, your willingness to be patient gives you an enormous edge. In a world where everyone follows the crowd, your ability to think independently is priceless.
The secret to not losing money is simply to avoid the mistakes everyone else is rushing to make. Don't use leverage. Don't speculate. Don't chase hype. Don't panic. Don't follow the crowd. It's that simple. If you can avoid these obvious mistakes, if you can stay disciplined and patient, if you can think long term while everyone else thinks short term, you'll do extraordinarily well in 2026 and beyond. Wealth isn't built by being brilliant. It's built by being sensible and consistent over long periods. Anyone can do this if they're willing to be patient and disciplined. Thank you for your time today. Now go out there and remember, the market will try to separate you from your money in 1,000 different ways in 2026. Your job is to say no to all of them and stay focused on what actually works. Good luck to all of you.